In today's video, I am going to be breaking down 5 different Vanguard ETFs that you can hold and basically have forever. So let's get down and let's check these out. So the first Vanguard ETF that we're going to check out is VUG. It's the Vanguard Growth Index Fund ETF. Its yield is quite low considering that I am a dividend investor. However, at 0.57%, that at least still gives you a little bit of a dividend considering it is a growth fund. With a growth fund, you're hoping that the underlying growth of your equity goes up substantially. The MER is really low as well at 0.04%, which means that for every $100 roughly that you invest, you are essentially going to be paying around 4 cents, which is not too bad. Obviously, this will go up with when the fund goes up. However, it gives you an idea as to how much it costs for Vanguard to invest your money through this fund. And considering that the average volume is 700,000 shares traded per day, it should be pretty easy to get in and out of. Now, this is a 5-year chart, and this is what you really want to see. In 5 years, this has moved from $100 all the way up to basically $300. Boy, wasn't that a buying opportunity. You could have literally doubled your money in less than a year if you got it at the bottom. This does pay every quarter when it comes to the dividend as well, and if we look at December over December, the dividend did go down. However, when we look at, let's say, a couple of years ago, December 2017 to December of this year, or this past year I should say, then we do see still a little bit of a drop. Could this be because of COVID? There's a potential for that, considering that if we look at December 2017 to 18, there was growth, and from 18 to 19, there was a little bit of a decline, so maybe not. However, you are still getting massive growth. Now, the top companies in this ETF are Apple, Microsoft, Amazon, Facebook, both of the Googles, Tesla, Nvidia, Visa, and PayPal. All of these are really good stocks, and probably my favorite right now out of all of them is Apple. My least favorite would be Microsoft and Facebook. And that's not because of the fact that they may not be good stocks into the future. I think they're going to be fantastic stocks into the future. I just don't morally, correspond with those two companies. Next is the Vanguard Information Technology Index Fund ETF, VGT for short. The expense ratio is a bit higher at 0.1%, and the yield is also a bit higher as well. You are getting an average volume of 500,000 shares traded per day, so it should be fairly easy to get in and out of. You are also looking at a stock that's gone from just over $100 5 years ago to now being worth over $400. So if you can 4x your money in 5 years, you are doing extremely good considering you're still getting paid a dividend throughout those times. Now, I'm not a huge proponent of reinvesting your dividends in the exact same thing you already are invested in. I like to reinvest dividends in something totally different. That way you can be diverse. However, if you were to look at an ETF like this, considering that it's such a small dividend anyways, if you could reinvest that dividend of that 0.6% and then watch your money grow at 4x plus whatever it grows on top of with that dividend, you're going to be doing extremely well into the future with this ETF. Again, looking December over December, we are looking at a little bit of a growth in the dividend this time. And then if we look at December over December of 2018 to 19, we're looking at a small raise again. So this is a much better dividend paying ETF than the last one. Again, very strong companies in the top 10. The top 10 does take up about 58%, 57 to 58% of this ETF. Apple always going to be one of the top companies in most ETFs that are index ETFs. However, some differences when it comes to this ETF from the last one is Adobe, Intel, Salesforce, Cisco Systems, and MasterCard as well. In the third ETF, we're going to be looking at Vanguard High Dividend Yield Index Fund ETF. This is VYM for short. And what we are looking at here again is going to be a much better dividend. Now, this is one, if you are a dividend investor like myself, then this may be a fantastic option because you're still going to get a very good return on your investment. So you are getting a 2.8% dividend, which is great if you are a dividend investor. You're getting 1.2 million shares traded on average every single day, and the expense ratio is 0.06. So that's extremely low. This is the reason why I am a huge fan of ETFs over mutual funds. Now, this isn't insane growth. You're going from just over $70 all the way up to about $100 and let's round off to $110, which is just over a 50% return over 5 years, but you are getting paid a dividend throughout this time. And if you're like me and you try to live off of dividends, then at that point in time, you are getting still really good growth over that time and an income while you're waiting for your money to grow. Now, this one again does pay a quarterly dividend, and I do again like to really compare year over year dividend increases, which we see from 2019 to 20. And then if we look at 2018, we see another increase. And even if we go down to 2017, we see an increase as well. So as long as this dividend is increasing, in my opinion, you're doing really well. This next ETF is VHT. It's the Vanguard Healthcare Index Fund. Now, the reason why this one is in my top is mainly because healthcare is going to be a bigger and bigger focus going into the future. Just like how green energy is going to be a big part of the future, Tesla and companies like that, what you're going to be looking at here is, of course, a healthcare, just absolute tons of money going into the healthcare systems. We see Biden in the States really wanting to fund more and more healthcare companies, obviously because of these different vaccines and, of course, just the overall, health of the country could benefit from higher investments into these companies. And that's why I think that healthcare could have a big boom over the next 8 to 10 years. The expense ratio is pretty low at 0.1%. And the yield is not bad at 1.15. We have to remember as Canadians, if you're a Canadian watching this, that American companies don't really pay the same kind of dividends as Canadian companies. Canadian companies are dividend happy. American companies want to reinvest in their own companies, right? Average volume is 200,000 shares traded per day at $260. It shouldn't be all that hard to get in and out of. Now, over 5 years, we've seen that it was around $100 to $125 5 years ago. It's doubled since then, which is pretty good. Obviously, this was kind of odd. I never understood why the healthcare systems actually went down during a COVID crisis. You would expect those things to just spike through the roof, but it didn't. And it dipped severely, and then, of course, started growing since then, just like the whole entire market. Now, this is why I think that healthcare could have a big boom. The entire market's done this. This is not special. However, what is special is the fact that there is going to be potentially more investments into healthcare, and if that's the case, there's going to be more research. More funding means more income, which means that this should continue to skyrocket into the future, in my opinion. Now, when we look at the dividends, they are paid out quarterly. And again, if we look year over year, we do see a massive raise going into 2020. And then if we compare year over year again, we see another pretty large raise. This seems to be something across all the healthcare ETFs that they're getting a fairly large raise on their dividend every year. That's exciting to me. Obviously, there's some blips right here in 2019 where the dividend went crazy. However, overall, on average, we are seeing an increase year over year, which is exciting. Obviously, these are some of the top medical companies in the world. One of the ones that I am absolutely excited about is Pfizer for one, and then also some of the companies that are farther down on the list that don't show in the top 10, like Moderna. At least those are the companies that are really starting to research into CRISPR, which is a new style of that mRNA, I guess you could say, because it does use a little bit of RNA in their sequencing. However, CRISPR is able to change your DNA, while mRNA is able to change your RNA. And it's a long story how CRISPR is able to work with RNA. Basically, they use RNA to be able to move those Cas9 cells or genes or whatever you want to call it into the cells that they need to be basically work on. It's a very long story. I'm probably confusing you. I'm probably not making too much sense anyways, but something to research yourself about anyways. It's really exciting stuff. But either way, healthcare is going to have a big boom in my opinion, and these are some of the top companies in that space. Another great option would be something like an ARKG. That might be an exciting option as well, but that more or less focuses more on the genomics side of healthcare. And then last is Vanguard S&P 500 ETF, VOO. Everyone should have their first $10,000 to $15,000 invested into a broad market ETF, something like a VOO or an SPY. I personally prefer VOO over SPY. The volume is much lower than SPY. However, what you are getting generally, and I've done the breakdown before, is a little bit of a higher percentage, and I think it was a 0.1% higher return on the equity side. Overall, what you're going to be seeing is massive growth. We're seeing about $200 per share 5 years ago, turning into $400 today. You're generally going to have about an 8% return per year on an index fund when you're looking at the S&P 500. So that is absolutely fantastic. That's why I always say your first couple thousand, 10, 15,000 should be in a index fund, mainly because it's going to be a nice steady return. Obviously, we're going to see some blips, but you don't want to sell during blips. You want to buy more. We have to remember what Warren Buffett is. Be fearful when others are greedy, and be greedy when others are fearful. And that should be everyone's investment model. Overall, you're going to be seeing very similar dividends across both SPY and VOO. However, there is that small, slight bit difference, it seems like, every single dividend when it comes to the percentage. However, if we look year over year, do we see a raise? No, we do not. Do we see a raise again year over year here? We do. So I would assume that obviously this is COVID. It's going to again increase into the future. So that's my breakdown of different Vanguard ETFs that you could hold forever. I hope that you've enjoyed today's video. Leave your comments down below, and also remember to do your own research. Don't just trust a random person on the internet. I'll see you guys again next time.